Hi there, welcome to kneppyinvests. Today's video might be one of the most important videos I have done on YouTube because this question does get raised a fair bit. I am primarily a small cap stock investor simply because I love trying to find those companies that are small today that can grow to behemoths tomorrow. The question is, how do we find those small cap stocks that can grow into large companies tomorrow? And I'll be discussing that very thing in this video, and I'll be looking at an article that was released 2 months ago and really focusing on what this guy talked about in that article. It all comes back to why I'm obsessed with Appendix 4Cs and how that is relevant for finding these small cap stock companies that can grow into large companies tomorrow, and also the importance of looking at cash flow statements. This is the agenda for today's video. First, I'll discuss the motivation and inspiration behind me doing this video. The inspiration was an article that was released April the 22nd, 2021. I've mentioned it once in a video about 2 months ago. And then I'll focus on that article talking about monetary stimulus, the rise of retail investors, EV to sales, the performance of positive operating cash flow small cap companies versus the performance of negative operating cash flow small cap companies in the past year and over the past 20 years, and how that's shifted to really benefit, how times have shifted to really benefit companies that are negative operating cash flow, which should be the opposite when you look at the long term. Also talk about this Warren Buffett quote, how you don't want to be caught naked when the tide comes in. That will make more sense when we look at the article. And also to talk about why I'm obsessed with Appendix 4Cs. It all comes back to these quarterly reports, and I'll talk about my mission for the June quarter Appendix 4Cs that have started to be released. In fact, the first Appendix 4C was released on the 6th of July, and it was a very positive Appendix 4C released by XREF. I'll talk about that very briefly, and more than likely I'll do a video on XREF tomorrow, so have a look out for that video. On the 5th of July, AVA Group released a profit upgrade to the market. The market did respond positively to it. Share price increased something like 13%. But even with that increase in share price, the market cap of this company at 47 cents, and currently when I'm doing this video, the share price is actually at 44 cents. The market cap is $114 million. And when you compare the market cap to the revenue and the operating cash flow, you just get a bit of an inkling there is some good value here. So revenue of $60.8 million, operational cash flow positive of $13.4 million, and both of those are growing quite quickly as well. So when you calculate some valuation metrics, enterprise value to operating cash flow 7.5, P ratio 6.5, and price to sales less than 2, should suggest this company is not growing much at all, or perhaps is going backwards. Someone in the comment section of that video that I did yesterday on the 7th of July in regards to this trading update asked me what my intrinsic value of AVA Group. I don't like DCFs because the amount of assumptions you have to make, and some people, a lot of people, underestimate the growth rates of a lot of quickly growing companies, so they undervalue the companies. I still got a DCF of $2.50, even though I was being conservative with the growth rate of this company. One thing I do like to do is doing reverse DCF. So instead of doing the DCF and getting a share price, what you do is start with the share price right now and then work your way back, and then you can get an implied growth rate of earnings per share or free cash flow that the company has to go through the next 10 years to justify the current share price. And when you do a reverse DCF for AVA Group, the market is saying the earnings per share of this company has to go negative 9% in the next 10 years to justify a share price of 47 cents. So the market is saying this company won't grow at all. In fact, it's going to go backwards in the next 10 years. And simply, over the past 3 years or so, this company has grown at really good rates. So to think that this company is going to go backwards over the next 10 years is a ridiculous thing to think about, or even make, or even just imagine. The mispricing of AVA Group right now by the market is the motivation behind me doing this video. The inspiration I found 2 months ago was an article written by Marcus Burns of Speria on the 22nd of April. And that article was the key to finding small cap winners amid a king tide. This was released on Live. Wow. So over the next 5 or 6 slides, I'll be talking about some of the things he raises in this article. And eventually we'll talk about one of the best ways, if not the best way, to find small cap stocks that are going to become winners in the future. Initially in this article that Marcus Spears released, he was trying to understand the forces behind the rise in valuations of a lot of small and micro cap companies on the ASX, particularly concept stocks. He started talking about a king tide, lifting the valuations of all these companies. So just think of that king tide as a normal king tide you see once or twice a year here. It lifts all the boats, or the king tide lifts all the boats. And what's happening now is these forces right now that are lifting the valuations of these companies is not sustainable. So what are these two forces he's talking about? The first force is monetary stimulus. So the RBA has increased the M1 money supply over the past year by 29%. Over the past 20 years or so, the M1 supply has only risen at 12% per year. So you can see a significant rise in the M1. So if you don't know what the M1 is, it's just highly liquid assets or money, that sort of thing. And right on the bottom here in the article, he actually shows us the graph of the M1 supply in Australia, but I've just given you here the American increase in M1 over the past year. You can see it just exploded. So all this cash, all this highly liquid assets have come onto the market really quickly. And that's one of the forces that is lifting the valuations of small and micro cap companies on the ASX and around the world. The second force that Marcus Spears talked about was the rise of retail investors and passive investing. Over the past year, a lot of new investors have come into the market, and a lot of these new investors are being induced by the story of a stock or a company. And in my opinion, the best management for a lot of these companies are the sort of management that are more like salespeople who are able to market and sell their company, their stock to these new investors. And what's happening now, a lot of these new investors coming into the market are doing very little research or any fundamental analysis, and they're just buying what is popular. Very similar to, say, cryptocurrency. It's been popular, so people are putting all their money into it without even knowing if there's any fundamental proof behind the valuation of these cryptocurrencies. The other thing he's talked about was passive funds, and how do passive funds select their stocks to be put into their funds? Well, it's not based off quality or valuation, it's just based off their size. If the size of a company rises, these passive funds put more money into that company. And that is adding fuel to, say, the fire of the rising valuations of these concept stocks. The next thing that Marcus Burns, apologies for calling him Marcus Spears, is discussing the rise of the amount of companies on the ASX with high EV to sales. And this was sort of proof that a lot of these concept stocks are rising in valuation on the ASX. And they're the major beneficiary of what's happening in the markets right now. And unfortunately, a lot of the new investors buying into these concept stocks right now are swimming naked. And when we have a king tide, it doesn't matter they're swimming naked. We don't know that's what's happening. But just like every single other king tide in history, eventually it will go out. And when the tide goes out, all those investors who are swimming naked will be seen. And you don't want to be swimming naked. A lot of these concept stocks have been labeled as disruptors or next-gen tech. That's how they're being sold by the salespeople who are running these companies. And at the moment, the share price of these companies are at all-time highs. Most of these companies don't make any money at all and are on extremely high multiples like price to sales or EV to sales. Marcus Burns, I think I might have been calling him Marcus Spears, but Marcus Burns included this table or this graph in the article, and it's just looking at the amount of companies on the ASX that have an EV to sales ratio of greater than 10. It's absolutely ballooned in the past year. Pre-COVID, you found about 150 companies with an EV to sales of greater than 10. And now it's around 250. He also mentioned in the article, any company with an EV to sales of greater than 5, they consider expensive. So there are a lot of expensive companies on the ASX using their sort of terms. I consider anything above 10 to be highly expensive. So I think that I've slightly adjusted that upwards over the past year, simply because of this ballooning in valuation of a lot of these companies. Then Marcus Burns get into the whole reason I actually read this article. He talks about the performance of operational cash flow positive companies compared to operational cash flow negative companies. History shows us small cap companies that are operational cash flow positive should outperform companies that are operational cash flow negative. We do have proof behind that. And actually in the article, he does show us a particular graph which tells you how to find those small cap companies that will become winners in the long run. But this has all flipped in the past year. In fact, negative operating cash flow companies have significantly outperformed positive operating cash flow companies by 160% to 25%. This does not make sense at all to me. This just shows you that those concept stocks, a lot of them will never make any money in the future, are outperforming these companies that are real, that are producing money, are producing profits. And this is one of the reasons why AVA Group is being completely ignored by the market right now, because it is profitable. It is generating cash. The market right now doesn't like that. They want to know all about those concept stocks that aren't making any money, that people are just being sold to, that these companies will become enormous in the future. And more than likely, about 90% of these concept stocks will completely fail in the long run. These companies that are making money right now are producing cash flow, are profitable. The significant amount of those will actually survive in the long run. Why are these negative operating cash flow companies outperforming the positive operating cash flow companies? Well, it's all about zero cost of capital. And we know through history, through any sort of logical thinking, that the zero cost of capital won't last in the long run. It is going to go up. And the whole reason behind this flip will come to an end eventually. And that's when the tide will come in, and you don't want to be caught swimming naked. Warren Buffett and Charlie Munger have a multitude of really good sayings, and this is just one saying from Warren Buffett. Only when the tide goes out do you discover who's been swimming naked. And this will happen with the markets right now. Even though we're in a king tide, no king tides last for a very long time. The tide will go out, and those investors who have just bought these concept stocks will be found be swimming naked, and you don't want to be caught swimming naked. Hope you like this photo in the background. This is taken in Yosemite on top of Clouds Rest. If you ever go to Yosemite, I highly recommend doing this hike. Fabulous views, 360 views. This is a photo I took just a few days after it actually did snow. Highly recommend this hike. It is a pretty grueling hike to get there, so only if you are an experienced hiker would I recommend doing this hike. One of the most important things to learn from this video, hopefully, is to understand that you shouldn't be caught swimming naked. So if you are buying a lot of concept stocks, buying the stories, a lot of these companies, just be aware that a lot of these companies won't make it in the long run. Because when it comes to small and micro cap companies, cash today is king. Those small cap companies that can produce cash right now have a much better chance of survival in the long run. Those concept stocks, more than likely, they will not survive. And here is the simple proof behind that. Looking at a much larger sample than 1 year, this goes back 20 years ago, looking at the performance of operational cash flow positive companies versus a benchmark and negative operational cash flow companies. In fact, a positive operating cash flow small cap company has grown at 872% over the past 20 years. The benchmark has grown at 323%, and negative operational cash flow small cap companies have lost 5%. On occasion, you can see the negative operating cash flow performance has gone up at a fair clip, but that does not last very long. And this is the whole reason I am obsessed with Appendix 4Cs. Why am I obsessed with Appendix 4Cs? Well, an Appendix 4C is virtually just a cash flow statement for the past quarter. And in that Appendix 4C, you can see the cash receipts of the company, and you can see if the cash receipts are growing. That's one thing I look for. But the most important thing you can see is if a company is operational cash flow positive or negative. That's the main reason I look at every single Appendix 4C that is released to the market every 3 months. And right now, in July, we're starting to see these Appendix 4Cs for the June quarter being released. We've had one released on the 6th of July, and that company, XREF, saw the share price rise 20% in 1 day. And why did it rise in 1 day? Well, they showed to the market they are operational cash flow positive. I have developed a new mission over the next few months. I will do a video on every single company that releases an Appendix 4C and that provides us with a positive operational cash flow quarter. I will do a video on that company, every single one, simply because those are the sort of companies you want to buy into, not the concept stocks. We've seen through time, those are the companies more likely to be successful in the long run. A sneak preview of a video I will release in the next few days. XREF is the first ASX company. They released a June quarter Appendix 4C. They released that on the 6th of July. Not only did they release this Appendix 4C, it was an operational cash flow positive quarter, so I have to do a video on this company. And the share price rose 20% on the day simply because they were operational cash flow positive. So you can just see the power of a company hitting this inflection point. But you might say to me, well, over the past year, operational cash flow negative companies have outperformed these sort of companies like XREF. But that's only been happening over a year. History shows us XREF sort of companies that are operational cash flow positive outperform those concept stocks. And most of those concept stocks will fizzle and die in the long run. How do we find the best small cap stocks? It all comes back to Appendix 4Cs that are released on a quarterly basis, going through all those, looking at the companies that are operational cash flow positive, and also looking at the half-yearly and yearly reports and figuring out which small cap companies are operational cash flow positive for the half year or the year. I do that religiously every half year and every quarter, and the success rate is quite high on investing in those sort of companies. That is all I have for this video. If you do have any questions or any comments, make sure you leave it in the comment section of this video. I'll answer anything you have to say ASAP or whenever I have time. This is the last thing I should say is I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.